All right. So today is part of our education series, and I want to cover my trade rules and sizing rules, I guess profit taking, risk management, trade execution, right? And this is really foundation setting things, right? Okay. So for any trade setup, you want to have a plan. All right. And when you're developing a trade plan, you want to have the most basic fundamentals set up and then slowly build off of those and then slowly refine those over time, right? So you want to identify a trade idea. It can be literally anything. It could be sentiment on the index is at extreme lows, and so I think it's time for reversal, like a contrarian idea like that. CEO bought a bunch of shares and I think it's going to go up. Certain news came out and I think that there's going to be a continuation run up proved by some technical analysis that I've done, right? There's your trade idea. Next, you want to determine the risk of the trade, right? You want to have an idea of what the stop will be. Okay, how far against my direction will this go before I have to say my idea doesn't work and I have to cut the position, right? As a trader, our job is to let the market make us money, right? We play into trends and we just capture the trends, and our job is to sit here and cut things that don't work and cut things when they start to play out, right? Thinking in that way removes ego from the process. It stops you from being like, I'm a genius. To get overconfident, you oversize and you blow up your account, and then you're sitting there like, why did I do something so stupid? Well, it's because you let your emotions get in the way of the process, right? So then we also want to systemically lock in gains and at the same time ride winners, okay? So you can have whatever process you want for this. You could be reading candlesticks and have a process for this. You could have certain key targets you want to watch for this. I have several different systems that I like to follow, such as the 5-bar rule, exact percentages. It kind of depends on what trade, what the catalyst looks like, what the setup looks like, variabilities. But I have an idea when I take the trade. It also depends on market environment. That's a huge factor. But I have an idea of how I want to be taking profits before I take the trade, right? You know, maybe I want to be exiting at 20%, 40%. There's a key target I'm hunting for, and then I'll leave like the last 1/4 of the position on for the target. This changes in a small account. We have a small account series on shorts. There's a nice playlist of it on my Instagram, Nobel Trading on Instagram. You can go watch that, where you see that I started with $90. I grew that, and how I rolled those positions is a lot different than what I would do in a larger account where I can buy multiple contracts and simply sell off part of the position, like in fractions. And that way I'm still riding the winner, but also locking in gains. When I'm locking in gains, I'm de-risking myself and I'm making sure I'm keeping some profits. And the goal is eventually the remainder of the trade you can just let run for free because you've made more than is currently still in the position. Or if that's not the case, then you take a portion of your profits, either depending on how likely you think it is going to get a continuation, maybe like 10 to 30% of your profits you put back into the trade. We call that a roll, right? Honor stop loss, we kind of covered that, and then review and repeat, right? Your data, I don't believe in back testing markets. I only back test trades I've taken. For those of you who don't know what back testing is, lots of people like to do research where they'll back test certain technical analysis and see how repeatable it is, or if it gains an edge on a historical framework. If I took this same trade idea for the past 3 years, would I consistently make money? I think trading is an art and not a science. That's been my experience with it. So I've tried to make trade bots. I have had some success with that, but at the end of the day, it still is very discretionary, in my opinion. So I don't like back testing. And I think that, when you're thinking about like what institutions do, because usually when people are back testing, they're thinking about like a copy paste framework that they can use, right? My trade style does not do that. It's still discretionary based. And so me looking at different setups and saying, well, this technically fits the structure, but maybe there's just something about it I don't really like. The market environment I don't like, something to that extent, right? That discretion, I think, makes this more of an art than a science. And it's something that people who are trying to automate trading fully don't really understand. And usually when you're talking about like institutions or something that run automated trading algorithms, first of all, they've rounded up your geniuses from the top universities, these crazy mathematicians who do usually forward projections. And nowadays it's like also enhanced with AI, who do high frequency, really rapidly fast trades. Or are programmed around reacting to news as fast as possible, faster than anyone else, faster than any human can, right? So that's where those really excel. I don't really think that works for the average retail trader. I don't think it's worth your time to do that. So when I say review and repeat, I mean you're doing your own back testing, but off your own trades. So you're going back, you're looking like, oh, this is an idea that has made me money multiple times, because you should be logging in your notes, in your trade notes. This trade worked, that trade worked. Here's why I think it worked. Here's what I looked for to take the trade, right? And when you see those happen over and over and over, then you can develop like a playbook. And for those of you who are like pro members, you guys have seen my playbook. That playbook is built off of years of like, these repeatable ideas have made me money and seem to have a really high win rate, based on many attempts and lots of money lost and made. First, a lot lost. So this is for any trade, a day trade, swing trade, Forex trade, bond trades, everything goes with this system, right? For futures, there's going to be slightly different. So make sure you read through our futures education for maybe trading like micros or something. I prefer the triple P method. I don't know if that's in here. If it is, we'll get to it. I think it's actually just in the futures section though. For swing trades, trades that are going to take multiple days or multiple weeks. So I identify a stock with a clear bullish or bearish sentiment. I also typically usually like it to have good market alignment. So in a bearish market, I like to look for bearish ideas. In a bullish market, I like to look for bullish ideas. If I'm in my swing trade account, what I typically like to do, especially if I have not holding a bunch of cash, I like to have like 80% of the account long in a bullish market and 20% short in a at the same time though, as to serve as a hedge for the rest of the account, because options are very volatile. And I don't want to ever put myself at risk. So if my account, if I have more than like 50% of my swing account in different positions, I usually like to go through and make sure at least like 20% of those are bearish, right? So that's kind of how I handle the portfolio construction outside of just the individual trades. So I like to find catalysts within 20 to 120 days. We have a full walkthrough of what makes for a catalyst if you're curious on like what type of things I look for. I use Elliott waves or key levels to determine my targets for profit. I'm also using many of our different indicators. Again, that's another educational document you can check out. I use RIPs or EMAs often to confirm that the trend is intact. Usually the 921 is great for, like a continuation of a bullish trend. And then same thing, I'm just systematically locking gains and writing winners like I typically would. For day trades, I find stocks that fit the playbook setups and have catalysts, headwinds, tailwinds. They don't have to have catalysts. Particularly, sometimes a pre-market setup can be really good. Typically, that is because there's some sort of catalyst, tailwind, or headwind, and I'm just not aware of it. And sometimes, You got 5 minutes till the market opens. Something looks really good. You don't really know what's going on because the ticker like hit your scan tool or something, and you just set it up, right? You may not size the way you should because the catalyst is really good and you're unaware. So be it, right? But you take the trade because the setup's really good. But you have to still control your sizing, as if you don't know the information, right? Because you don't. Okay, you can go review, and then you could put the critique there of like I should have known this, right? Of the information that could have been available to you, because you just don't get caught up in that 2020 hindsight, right? You want to put yourself back in your shoes when you took the position with the information you had, because we always operate with an amount of uncertainty. You can't know everything, so keep in mind that you don't fall into the hindsight trap when you're doing that. Identify the key levels, both, on larger time frames. Make sure when you're day trading, you're not also missing like big daily key levels. Really important that you don't make that mistake. So make sure you're not just on shorter time frames, but also on longer time frames. Use technicals to confirm pivots, extensions, fibs, EMA, clouds, TMT, squeeze. That's all standard. I'm not going to cover usage of these. If the trend is strong or a lot of, play 0 DTE. If weaker, play weekly. I really like this because, if you're like R-vol is really low, but you think this can, your R-vol being relative volume, if that's really low, but you think that you could catch a continuation, or you're looking for something like a gap fill, I would keep theta at bay by continuing to roll the position and give it time to play out. And that's how day trades often turn into swing trades. If like, okay, this isn't really working out, but I really like the idea. Maybe there was a headline that happened that kind of threw the whole market off, and now the stock isn't playing out, but it's still holding relative strength. Okay, maybe I roll that position out with some time, and I see if that wants to come back to me, because it's not hitting my stop and it's become stagnant. Roll it out with time. Definitely, I don't sit in short-term positions if they become persistently stagnant. At least I don't want to, because that usually just leads to volatility getting sucked out of the contracts. So you get that premium decay, and then you're just begging theta also to rip it out. Theta gets usually pulled out of contracts around noon, sometimes earlier if there's like a half day coming up, or a holiday or 3-day weekend or something. They could pull it out sooner than that. Systematically locking gains, same, always systematically, always taking profits when you have profits, and keep in mind, if you, let's say you swing a position and it's up dramatically, what I love to tell like new traders, if it's good enough to screenshot, it's good enough to take profits, just close it out. Roll with a small portion of your profits immediately. Just lock it in. There's so many crypto guys who are, I've seen so many new crypto traders blow up their entire accounts because they constantly feel like they need to be either all in or all out, because they are desperate for the next trade to be the trade rather than the next trade just being the next trade. Do you understand? The next trade mindset is what you want to have. The idea that I get rich over 1,000 trades, not one trade. So I'm always looking for the next trade. Trade failed, okay, next trade. Trade won, okay, next trade. Right? You're always just looking for the next trade, regardless of what happens. Keeping looking forward. There's a lot of. It just does so good for your mentality and psychology to have that mindset of looking for the next trade. I'm kind of getting too much into the psychology. We have a full educational thing about that as well. Stock price targets matter. I focus on stock price targets, not option price targets. The goal is to exit when the underlying stock reaches key levels, not when the option price looks enticing. Options fluctuate based on volatility, theta decay, other factors, but stock prices remain the anchor point for a trade. And this is so huge, right? Because there is frequently like manipulation on options chains. So if you're on something that's a little more illiquid, but you really like the catalyst, you want to keep the exposure. Oftentimes algos or even just other traders will start to manipulate the chain, and they'll start to You know, you'll see like a 50% loss, even though your stock setup is just fine. Or there'll be a premium rug on the greater market, but the stock you're watching still looks fine, but you're still getting that premium decay. If the position looks fine, again, you can always roll if it's a bit weaker, like we already discussed. But you also want to be watching the stock chart and not the option chain to see if it plays out. The other thing that this does, by the way, is it prevents you from the temptation to make emotional decisions by watching the percentage of the option kind of dance around, right? If we just watch the stock chart and we just watch our stop that we set, and then we watch our targets as well, it puts you in a better mindset to just let it play out and keeps the caveman brain at bay. The caveman brain does not like, that's in the back of your mind, that's constantly poking at your subconscious, whether you're aware of it or not, that hates uncertainty and wants you to get out, or wants you to just do wild things that are going to cause you to lose money, right? So just watching the stock price could be a lot better to help with that. Risk and account size. Trade management starts with account management. If a position grows too large relative to my account, I roll it and lock into profits. This keeps risk in check while allowing me to stay in the trade if the setup is still valid. So this is this really only applies to small accounts, right? If you are in, if your account's over 25K and this becomes a thing, where a single position has grown to like a majority of your account, you are doing something probably very, very wrong. But if you're in a smaller account, and go watch the series on Instagram and you can see this kind of play out in real time. Because in the small accounts, you are inherently having to take more risk, which means you constantly have to micromanage it. Managing theta exposure. Time decay can eat away at option value, especially as expiration approaches. To mitigate this, I sell against my position to create a vertical spread, reducing risk while staying in the trade. The goal is to stay in the game without theta draining my profits. Now, I don't actually do this very often, but it is a different way. Instead of snagging, buying a new contract with more time, especially if you're in a smaller account, you can instead, if you're in a call position, you can sell a call further out the money, right? And that creates a spread, which then mitigates theta decay because the contract you sold is the theta is playing in your favor, while the theta decay on the other contract, since theta is based on expiration and not strike, they cancel each other out, right? So I think that's best in small accounts, but I typically do not. I really don't do this that often, but it is something that you should do if you're in a smaller account and you're trying to learn, and you don't maybe have the capital to, you can maybe let's say you can afford to put a tenth of your account into a contract that expires at the end of the week. But if you go out an extra week, that same the same strike would cost you, half your account. So you can't afford to take that position. Keep in mind, you could also do both. You could buy the extra week and then sell a call further out the money. You have to play less for the position, still get the extra time. But what you are also doing is you're also limiting your upside. So that's why I frequently don't do this, because a large majority of the time I have a good win rate, a good hit rate, and so I'm not really looking to minimize my potential returns. I'm just letting trades win or lose, and I let the probabilities play out, and they most of the time play out in my favor. Over longer time frames, they have done very well in my favor. Emotional control, again, this is going to take you to the psychology document. Emotions are running high, a position is too large. That's a sign, right? You can get edge just by having good emotional control, because most people don't, right? And you keep in mind, that's a lot of what you're competing against, is people who are not making rational decisions and giving up money. And remember, this is a zero-sum game. Every time you're making money, someone's losing money. I like to think that I'm taking money away from people who are douchebags. Makes it more fun. No automatic stop losses. I don't use automatic stop losses or buy orders. Market conditions dictate my decisions, not preset triggers. This is, when I say preset triggers, I'm saying that I'm not putting in like an actual stop order. Now I will sometimes break this if for some reason I've got to walk away, but I really want to leave that position on for whatever reason. I might set in a manual order. With futures, I automatically have a stop set every time I take a trade, a percentage loss, because with futures, of course, you could take a trade and it just immediately goes in your direction. So having an automated stop that is automatically placed every time you enter into a trade, I think is very smart. But as soon as I enter into the trade, I'm going to adjust that to where I want my stop to be. And I will manually adjust it if I feel I need to. Gotta be careful with that. If you're newer, because you'll find yourself just continually adjusting the stop and then blowing up your account. So careful with that, but make sure you're obeying it. And that's why with futures on shorter time frames, algos know that, or even can see the orders that have been placed on the open market, or they're coded in a way where they play on retail traders' emotions, or not even just retail traders. I think it's very pompous when people just pick on retail traders. I'm a retail trader. I'll tell you what, I'm probably better than a lot of institutional traders, because they're not like this. They're not like perfect robots that make huge mistakes too, right? Hedge funds blow up and it happens, right? These people, pompous attitude's not worth it, right? But what those algorithms do is they know what traders in general will mostly push their stops, or where their psychology will lead them to make mistakes, and will often pressure that from the algos, because those algorithms play with very large capital sizes, right? So, and market makers can too, as well. Do that. There's lots of market makers who have written books and stuff who have talked about doing that at times. Cutting losses is the trader's true job. We've talked about this. Understanding probabilities. This is kind of goes into our psychology, right? We stay at a constant thinking in bets mindset. We constantly think about the risk reward of positions, and we think about the quality of our setups. We'll get into this a little bit more later. General trade management rules: never increase position size when losing. Trading is not investing. This is something you do when you're investing. This is not something you do when you're trading. You want to stay nimble, right? When I say stay nimble, I mean don't get pigeonholed. Don't think that this is going to happen today, and then the market immediately do something different and you try to fight it, right? You don't want to swim upriver in this game. It's not going to play well. You need a signal. You need something, a candle, or a technical signal, or a headline. Something needs to change for you to want to fight against the market on any given day. On longer time frames, when you're talking about investing, and there's investment you like, it's very cheap, and it's trading at a historical, low valuation based on whatever fundamentals you're using, or even technicals you're using. That okay, that's what you, and it's not working too. Okay, buy more of it. Okay, don't stay nimble, but stay convicted. But even then, we have very high convictions that we are very, we can easily get rid of them, right? I think the saying goes, have strong convictions, but marry none of them. So that's one I like. Okay, when pair trading, when running long and short positions with opposing trades, I let the runner win while allowing the loser to bleed. No stop losses, just smart management. So Yeah, if the market's in a full squeeze and all your long positions are winning, first of all, you should have good portfolio construction. So you in a bull market, you should have more longs than shorts. If the shorts aren't working, but the thesis still looks good, just let them bleed. This also, probably when I wrote this one, I was thinking about like market opens, things are lots of volatility right off the open, and people will immediately go to managing their losses. They gotta stop the losses, or managing existing positions when there's tons of when there could be other opportunities on the market. Like they overreact to the first moves. This can often play in your favor, but it often means you're losing opportunities, especially when like in my early days, I would constantly find myself in a position where I'm like rushing to close a trade that's like down 80% to save the last 20%, and then missing a trade that could have made me like 150% on that day because I was sitting there trying to, get out of this position that's bleeding me, right? You're almost better off just saying that's a lotto now. It can go to zero. What's the next trade? Next trade mindset, right? So that's also a big reason why I decided to put that in there. Cut losers, let winners run. Right? Totally counter to what I just said, but it was nuanced, right? Not hypocritical, just nuanced. Cut losers, let winners run, right? So if you're entering a new position and it's down 15%, it doesn't seem to be working, or it's even stagnant, get it out of here, get it off the screen. Don't be like married to the idea or have your ego or pride pushing you to like want to be right and then buying into something that isn't working. Remember, that's your emotions talking, because you can cut positions when they're down 5%, 15%, 20%, right? And then you could revisit them if they start to play out in your favor, and you can take them when the momentum's actually in your favor. That's day trading, right? Day trading means we're always here in front of the screens. We can re-enter positions. It's okay. Especially if you're talking about like a swing trade that has lots of time. Like, okay, we hit my stop. I still think it's going to work, but I'll wait till it actually looks like it is working. That does lead you to sometimes missing opportunities. Maybe you cut it, it starts to fire, to just re-enter, right? Or sometimes you just miss them, and that's okay. You're going to miss some. There's a million opportunities. It's okay to miss some. Never let a great trade turn red. Yep. Especially if you're in futures and something's green and seems to be working and then turns into the red on you, I'm out, right? The one time where I will sometimes allow this is if I've already locked in a good amount of profits, and let's say I only have a small fraction of the position still playing out. There'll be some cases where, maybe the headline hit and the position went in the red. And I'm like, well, I kind of want to leave the rest on like a lotto, just kind of see how it plays out. If we, if it's a big fake out, and then it will fire back to the upside or something. So there's some rare cases where if I've already taken some profits or already made a lot of money, I will let it continue to run. But typically, for most cases, if something's green, then turns red, it's working, and then suddenly it's not working, I'm getting out and reassessing what just happened. Okay, sizing. I get so many questions on sizing. And the reason I get so many questions is because I am very rarely going to ever tell any individual person exactly how to size their account. Because risk management is kind of like a right and wrong, right? But risk tolerance is totally a spectrum. Some people have really, let's say, loose risk tolerance, where they can handle a bunch of stress. It doesn't bother them. Maybe you're loaded. You run into businesses. You got 100K, extra 100K you're trading with, and this is just like a fun game for you. And so you're just like, I just swing huge at stuff, right? I still don't think you should treat it as trading as gambling. I think you should treat it with respect and take it seriously. But let's say, that person might say, I'm willing to put like 10K into a trade. Well, 10% of my account. or there might be some of you who are younger. You're working like a, like a, you're in the average household income. You're like 45K, and you've got like a $5,000 account that you worked really hard to grow, and you also have a savings or a long term, and then you have a separate 5,000 and a trade account, and you're trying to learn. Remember, discipline. If you don't have the discipline to save the money necessary to trade, the likelihood that you're going to have the discipline to be a successful trader, not huge. Just keep that in mind. So, with the A grade based on a $25,000 account, A plus grade, 3,000 or larger is what I would personally do. As someone who has been trading for a while, and I know how my emotions work. I would say that I, at this point, probably would go higher than that, and I probably was just being a little conservative when I read that. You want to work your way up to larger sizing is really what it is, right? So I wrote this in a very conservative fashion because you have to earn large trades through the emotional control necessary to watch large amounts of money appear and both disappear and not act in irrational emotional ways. Like, that has to be earned. And for a lot of people, it's a lot harder to earn than for some. There are some traders who, we have one of our traders in our community is been trading for a long time, lots of success. He's profitable. We all know he's profitable. I'm not gonna say who, but he can't handle large trades. It's like his nemesis. Like, he can't handle over I believe it's like 10,000 in one trade. He just can't. He can't sleep. It starts to bug him. He's constantly thinking about it. And that's like, okay, it could take years to get over that. And some people are like, this just is what it is. I make enough. I'm doing good. I'm content. And other people, some traders they love the love of the game, and they always like pushing it. They want to have like a 7-digit trade. So they push the exposure, trying to get used to the management of that. One of my favorite stories is from a legendary trader from London who accidentally one day made like 5 million in about 15 minutes. And he said he closed the trade. This is before like all the automated trading. He closed the trade, and then he looks to his assistant, who was like reading the tapes to him, and she's like, you just closed that you're up 5 mil right now. And he looked at her, left the trading floor, went to the bathroom, and threw up for about 20 minutes because he couldn't believe what just happened. So it's, everyone reacts differently, right? So even people who been in the game for a while. So have some humility when you're new, and understand that this is going to be very personal at the end of the day and take time. Anyways, all right. For an A trade, about 1,500, a B grade, 1,000, C grade or small, about 500. Roll up profits, 10. It looks like I put 10 to 50% here, depending on conviction. That sounds right, to be honest. That sounds about right. Lottos and $10 to $400, right? When you're taking a lotto, you're literally just saying, it's literally there's really nothing on the market that's giving me an edge that tells me that this could play out, but I think it could happen. That's a lotto. That's walking up or, driving down to the gas station, go up to the counter and paying, $15 for the lottery ticket and then scratching it off and see what happens, right? The money's gone instantly and there's a small chance it comes back, but you could hit the big jackpot, right? That's how I treat lottos, right? 0-day contracts. You may be buying the low and looking for a big reversal on the day or something crazy. If you're in a small account, avoid lottos. If you're in a small account, if you have $1,000 account, don't do lottos. Okay, earn this, grow the account, stick to trades you really like, and also A's are rare. A pluses almost never happen. I don't even know if I should have this on here, that there is such a thing as an A plus grade. This type of grading is like completely personal, right? There's nothing ever on the market that is an absolute certainty. You have to feel like it's an absolute certainty, right? If you go in the playbook, there's nothing that will say A plus trade. I'm trying to think if there's anything that I notated with an A plus trade. But that's personal. That's not something that can be derived from the market. A strong enough edge that guarantees a outcome, right? I can count on my hands over the past 10 years of my experience in markets where I've seen A plus trades, and then even for A trades, maybe like 4 or 5 a year. Really rare. And if it's a really shit market that's just like trading sideways the entire year, maybe 2 or 3. Really rare. It's supposed to be rare because it's an amazing setup. And so that's why this sizing is literally twice the size of this one. It has a plus sign for the A plus, right? Because you have to just believe that the stars aligned and you just know. And I think some of that comes with experience, because there's just certain patterns or occurrences or just moments where I'm just like, oh, this is going to make money. And you just know when that astrological point in time happens. Oh, I even put that in here. Good. A plus, multiple playbook alignments and personal convictions. And then A trade is 3 points. So key level break, catalyst, and good market alignment. And then should put it in here. Maybe this should be a 4-point system. It's also going to depend on what the pre-market structure looks like as well. All right. So pre-market structure, you know what? I'm going to write it in here. I'm going to do it right now. Pre-market structure, like if you're looking for a setup into the day, or in parentheses setup structure. Here's how I'll do this. Setup trades, structure, swing trades. These are going to be different for your analysis. That's probably also going to be 1 point, right? I'll put there. And we'll actually put you can have these hit, but have this be bad. At which point you should take away a point. So you might have all 3 of these, which would dictate an ace trade-in, but you could have a weak structure or a weak technicals, which means that you should remove a point here. I think that's complete now. But yeah, it's fairly simple. Each of these reads 1 point. You get 3 of these to align. If you go to all 4, maybe you have some personal convictions. You can size up for a really strong A. But just keep in mind, this is supposed to be extremely rare. You better feel like it's absolute certainty, right? And that's going to be it. This is just the overview. I think we covered this all pretty well. So I hope you found this helpful. If you want to learn more, make sure you check out all the free content that we have on the socials and the Discord as well. Talk to you there.